¿Qué hora es? Oye, eso. Vale. Next. Bueno, hola a todos.
Hello everyone, we're going to get started. It's 6 o'clock. Welcome everyone. Welcome also to those who join us online. And let's try to be punctual. And thanks, Paz, for the presentation that they delivered. They're very right. At Brainsfester, it's great to know oneself and to know how to face up to the many things that come our way in the investor world, and that's normally the key to success. So I always advise people to try and use this tool or others to learn as much as possible. Today we will be talking about very important things. We will talk about the key figures, we will talk about yields, profitability, portfolio structures, and what to expect from our portfolio. And we're going to do something that we have never done before. We are going to talk about our process, how we work, how we operate. We will break down the process for you. And finally, we will share some examples that will be delivered by Minkun. And before we get started, I'd like to mention that we're going to focus our presentation on the process, and we will be devoting some time to it, precisely because by the end of the year, we will change the naming of some of our funds or our author funds, and they will become normal management funds, because as we will see in our investment process, well, this is not about someone waking up in the morning with a light bulb on and just buying on some things. This is something that takes some time, and it's a work done by very many people. And of course, 7 years ago, we could consider that we were an author management company, but now we're not. So let's get started then. So key figures now. Here we are at 2.1 billion under management. And we have 27,000 investors. And there's a very important decision that we made, which was the decision to create Class A, which has a fee of 1%. And 1% vis-a-vis 175 over the course of 2 years amounts to quite a lot of money, as you can see if you do the math with a calculator. And it's always been our objective to get to this point. Unfortunately, most of our customers are in this class, and every year it'll have an extra 0.75 yield than Class D, which is the initial class. And we must insist on the fact that this is not a retention or commercial tool, because anyone can get their money back, and if they own still one share, they can retain the seniority. It's not about actually trying to stem the tide or anything. It's about trying to share the yields, the profit of companies like this with the main creditors of this earnings, which are those investors that invest with us and that we get fees from. And also something that is very important is that we have started Cobas Autónomos, a pension fund for freelancers, and it targets all the millions of freelancers that exist in Spain, and this offers fiscal advantages because, as we very well know, physical individuals that are employed by third parties, they have a cap of 1,500 euros, but here freelancers can go up to 5,750. And if you have a marginal income that is high, then this could help reduce the amount. So it is becoming quite successful, and we really hope that it will even be more successful in the future. Gonzalo Ricardo has been appointed new managing director, and I am at the head of the company, but the rest of the business is led by our general manager, who is Gonzalo, and that way we cover the rest of areas in the business. And now let us talk about profitability, about yields, and about our performance. These are our two portfolios, our two funds, which are the International and the Iberia Fund. We're at 125. This was a figure from Friday. We did this. We managed to perform better than the previous years, and our savings are maintaining their purchasing power, but we want to also beat indexes, because otherwise it doesn't make sense to charge customers, because if we perform as an index or worse than them, it doesn't make sense to charge 1 or 0.75 or whatever it might be. So that's our target, and we have been chasing up to the indexes ever since we got started. We are trying to beat it, to break the indexes, and normally we would. And if you actually see the next line, you see that the target price of the international portfolio 12 months, it's 279, with a growth of 13% approximately in the last year. And in the Iberia portfolio, we're at 289, with a growth of 20% over the course of the last year. But right before, I was looking at the target price for Cobas Iberia for next year. It's at 300, and for Cobas International is at 200 and north of 290. So this is still on the rise. Fortunately, the green line needs to point upwards, and normally the settlement values, the liquidation values, come close to this line. We don't know when or at what pace, and if it can be fast, like in the last few months, or in previous times, even deviating from some values because the prices were dropping. But we will now discuss the keys that need to be in place for this to happen. And there haven't been that many surprises, because actually, before we move on to the next chart, we would like to mention that the potential between 125 and 279 is huge, and this is the asset price for the companies that we have in our portfolio in Spain and outside of Spain. But let us go back in history. And the growth of liquidation value is happening without big shocks. We've had two in 14 years, in 2008 and in 2018-2020, moments in which funds dropped by 50%. And I was listening to Beth before, and I was thinking that the best learning that you can get in the stock market, investing in companies, is to have a drop of 50% and see what happens then. Because really, if you're capable of weathering that storm, you will be able to weather any movements in the market. So it is not pleasant, and in 30 years it's happened to me twice, and well, that's the way life is, and hopefully the next time will be in many years down the line. But in those extraordinary moments in which liquidity disappears because of abnormal situations, in normal conditions, the market movements are relatively small, normally bullish, with some years with drops. And in those years in which there are decreases, we behave quite well, we perform quite well. Our listing price is quite low, so normally in these environments, our companies perform better than the market. So we wanted to put on the table what has happened in the last 2 years, which is a good example of what has been happening normally in the last 30 years. In the year like 2022, in which markets were negative and decreasing, we had a positive profitability of 90%. And then positive times came, and the market revalued at 19%, and we revalued by 12%. So it's important to look at these 2 years together. So the market was at +4, and we were at +23%. So that was the natural trend. The natural trend for our funds over the last 30 years, we were going up the same as the markets when they increase, and we were buffering the drops as much as we possibly could. And this is very positive in those moments in which there's a total lack of liquidity, when investors actually sell everything. And I'm happy to see that this is coming to light and we're going back to a normal situation, the normal evolution of our funds that we've always had. And with the added value that things are going quite well this year with continuous improvements for funds. And now, let us see the foundation for this valuation, the valuation that is calculated by Ivan every single week. The foundation for this is that if we see our portfolio, the selection portfolio compared to any index that you may want to take as reference, in this case we're talking about European Bloomberg, we see that the return over capital, which is the quality of companies, which is above that of the indexes. Now, we must take into account here that we don't just talk about return over capital. This is not completely comparable, but the profitability of the capital of our companies is above that of the market, but the PER is lower. It's still at 6 today, even though the funds are at the historical maximum and on the rise. And we also have the free cash flow yield, which is the flip side of the PER. So we have 21, and the market is given 5. Because they're listed at 15 times profit, and then we have the net debt vis-a-vis EBITDA. We are 0.3, and we are working with investor families, and here we see that the control groups are at 70% for our companies. And we're talking about middle-sized companies. For large companies, it's much more difficult to find value. So for us, the market cap, the weighted market cap is for 4.1 billion. And then we have the VAR, which is a probability of losing more than 10% monthly with 99% probability, and in this case we are lower in our fund than the market. I don't know whether this would materialize, but these are the foundations. These are the financials, and indeed this sets us on the right track for good things to happen. Now, what is it that has happened to the portfolio? In the last 2-3 years, very many stocks have revaluated. Here we have the greatest revaluations that we've seen. And some may think, okay, this is dangerous because companies have risen, and as they rise, they can also fall. And that's true, but as we always explain, we concentrate our portfolio around those values, those stocks that are more distance from the green line than that we always mention, that their value. And some of these companies have reached their value, and we progressively sold them out. So what is it that has happened? That in this 10 stocks, out of this 10 stocks, so do we retain any in our portfolio today? We still have 3 of the stocks in our portfolio. We sold 7 of them. So only 3 of the stocks are still in our portfolio, Golar, Teva, and Elecnor, due to a very simple reason, because we think that the potential for the 3 of them is similar to the one in the fund, which is at 100% or above in some ways, in some cases. Why did we sell the rest of stocks? Well, in some cases there's been takeover bids, and we couldn't not concur them because the price would increase. And in others, we went to the market because our stock market price was close to our company valuation. And then later on, we will hear some examples. So what is it that we've done with the sales? Out of those 7 companies with those 7 companies that we sold, we've purchased some others, and we went back to the natural cycle to sell things that are increasing a lot, to buy those that haven't done so. So. There have been 15 companies that have been aggregated in which we have increased our positions, and we have repurchased them, and those have seen also a decrease of 20% in the last 2 years. And so we see companies of all sorts here, but we will discuss two examples here, which have been included in this chart. The first of them being CK Hutchinson, a Hong Kong-based company. Bin Kun later on will tell us more about it. They will tell us about this company that was listed at 90 or 100 2 years ago, and now it's at 38.5, I think it was this morning. So there's been a decrease of 55 or 60%. It was 54% specifically when we drew up this chart. And therefore, we have increased our position. We already had it in our portfolio, but we have increased our position with it. A new company. This is an example of a very well-known company, a pharma company, Bayern. They had aspirin, and they also have very important presence in agriculture and consumption. So there's been a decrease of 71%. They have some litigations that need to be looked into, and we did so, and we were convinced, and we bought this at a price. Well, there was a substantial, at a price that was good, and there was a substantial drop behind this. And it's always good to buy things that are decreasing their price, and especially that have the quality that buyer has behind it. And that makes them attractive, and they have been penalized by the market. So this is the company summary. As you can see here, there's been a decrease in our presence in energy. This is something that we mentioned in previous conferences. We were overexposed there, so our position has been decreased there. And in the shipping segment, we're no longer that present, except we've decreased our presence across most industries, except for oil and gas, in which we are leaving some of the companies but introducing others. We have increased our position in the defense industry, pharma, etc. And this has been the greatest movements that we've had in our portfolios. But we did want to give a more defensive edge to the portfolio, because after the big revaluations in the market, we wanted to be prudent and focus on some more defensive things. And our approach is always bottom up. We wanted to indeed see the type of companies that we prefer, and if we like them, we just go for them. If we find good companies and good business in some industries, we go ahead and invest. We don't really focus on what the cycle is going to be doing. Only marginally for the agrarian side, for Cobas Selección, it's 13%. So we have done something similar. We have cut back our position in energy, and we have enhanced our position in some other areas. And we go back now to our portfolio. So all in all, we continue to have a portfolio which is which has PER 6 times. And some people say that it's investor value, and they really focus on value, and they have portfolios at 17 PER. We will see what happens in due time. We know that we will get back our investment in 6 years' time. So I think that not that many management companies can really brag about this. We can really brag about having such a low price in their companies with such a good quality ROC of 32%. You put 12 into the business, and it gives you 30 in a very short term. So this is, to me, the key that goes to show why we will get to 300 sooner or later for the Spanish fund, for the international fund too, because if you put it in the market at 6, the market sooner or later will put it at PER 15, which is the normal measure. So now, before we start talking about the investment process, let us talk about the environment. And in order to do this, I'd like to mention that me and my family have been living in Singapore for 4 months, and at school they taught this map to our children. We're there cornered in that left-hand side, and we rarely exist there, right? And among the other things, traveling does this to you. It changes your viewpoint. And the global growth for this year is at 3.1%. It's similar to that of the previous year and next year. We don't really need to fight over whether it should be 3.5 or 2.5. It's better to be at 3 than 2.5%. But that's not really relevant for us. That's not the name of our game. Actually, we are at a global growth of 3%, which is the average of the last 30 years and will continue to be the average in the next 30 years. So we break this down, we realize that in Europe and the US, our growth is 1.5%, and in Asia, it's 5.4%. The driver behind this is Asian growth, and it doesn't look like this will be changing in coming years. These are younger economies, more dynamic economies. Generally, they're not as regulated as in Europe and the United States, especially in Europe. Normally, here in Europe, we're putting obstacles to growth, and it's not the case over there, especially in countries that are as important as China and India too. That slowly but surely they're getting rid of those obstacles to growth. Now, so importantly, things are happening, and things are happening that are sometimes not good for us. And in the last 20 years, what we've seen is that in developed countries, that's to say the United States and its allies, as we normally call them, the United States, Europe, and other allies, they have gone from amounted to 60% of the global GDP in 1960 to being now at 40% of the global GDP. And possibly in 20 years' time, according to these estimates, which make a lot of sense to us, we will amount to 30% of the global GDP. Strategically, this is important because if you only represent 30% of the global GDP, you cannot really be hegemonical, and this will go into directions that some others will have to analyze. In the meantime, the emerging Asia, which used to be 10% of the global GDP in 1990, possibly in 2040, they will be 40% of the global GDP. So we'll have to keep an eye on Asia. We will keep an eye on Minkum, and we'll get close to them because growth will be found there. It doesn't really mean that the financial markets will evolve better in Asia than in the US and Europe, but we need to ask companies what their growth strategy will be in those countries anyhow. So this is a drip drop, and this causes the contribution of the Eurozone in the global GDP in the year in 93 was 25%, and now we're talking about 14%, and possibly by 2045 we will be saying that Europe is less than 10% of the global GDPs, and 7 to 8% it'll be dependent on of how things happen. So it'll be almost irrelevant in the global context. Now, for what matters to us, investments and companies, the same is happening. The green line is investment in Europe of European companies. The stock 600, it's now at 40%. It used to be 20% 20 years ago. And we used to see how only a small amount of products was sold in Asia, but now it's 20% for these European countries. And this has implications of all sorts, and here we just wanted to illustrate one of them. In the global context, energy demand will rise in a consistent and recurrent manner. And here we have some estimates that say that it'll go from being 10 megawatts per person and per year in 2019 to being 12 megawatts by 2050. But the growth will not be equal for everyone. We see the different lines that represent the United States, Europe, Japan, etc., that go on the decrease, and others, especially Asia, go on the rise, and that's unstoppable. And 4 billion people practically don't consume energy right now, but they will move on to consume from 3 to 7 megawatts per person per year, and they will want to have the same air conditioning as we have in this room this year in India. And actually, that equals the energy consumption in of many countries together. So that's unstoppable, and they do want to live in the same comfort as we do. So this will have implications for us indeed, and these are things that we need to regard from a long-term perspective to factor them into our investment process. And this takes us to our investment process, and it's something that we have been discussing. We are no longer an author type of management company, and this year we will probably change our naming. We are made up by a team that has been working together for a very long time. We've been talking with Ivan Mencon and Carmen for 15 years. For Juan and Juan Cantus, it's been 10 or 12 years. But also with Vicente, we've been working for perhaps not so long, but he has a long-standing experience in the investment world. So obviously, we're no longer an author type of management company. And as ahead of the questions, I'm not going to retire or anything, but we wanted to show here the way in which we actually work in a clear manner, so that all those around us come to understand it, so that all those that trust our investment know it. And now Carmen is going to explain to us our investment process. Thank you very much, Paco. Well, as Paco mentioned, we are going to focus this year on the investment process. I will explain the theoretical approach, and then Juanca will explain a practical case. I'd like to mention that this is actually the process that we have been following over the last 30 years. The process is practically the same, but in the last 5-6 years, we have further standardized the process, we have further institutionalized it, and we make our decisions more together than before. And we have tried to simplify our process, and the process is more dynamic and more continuous than may appear at first glance. And it's a crafty, an arty type of process. It's more of an art than a science that we do here. So we wanted things to be more dynamic even. I'm going to start by talking about the way in which we create our investment ideas. Then I'll mention how we make our investment decisions regarding also different companies. And then I'll talk about the way the portfolio is divided into the different into the different components of the team. And then I'll talk about the portfolio construction. So the process begins with the idea that one of us proposes, and our sources are, for instance, reading. We devote a lot of time to it, and we get ideas from that. We also work with brokers that sometimes give us investment ideas. And then we have the value chain that refers to those ideas that refer to companies in our portfolio. We may, for instance, invest in competitors of companies that we already own, customers of those companies, or companies that do the same as companies that we own, but in different geographic areas. And then finally, oftentimes we travel and we attend investor conferences. We get together with companies there, and that brings us some ideas too.
Well, this initial stage for idea generation and to have a preliminary study can be more or less lengthy depending on whether we already know the sector or it is a new sector. So if it is a new sector for us, then sometimes this preliminary study could take us 1 to 2 months easily. And if it is a sector that's already in our portfolio, since we already know the dynamic and so on, maybe a week will be enough, or even less than that. We can get a general idea of whether it is a relevant idea or if we should do it or not. Now, with regards to the minimum requirements in this early stage and in general, is those that we have always mentioned. It needs to be an easily understood business. We need to have long-term visibility. We need to be able to have reasonable transparency to see what the business will look like in 5 to 10 years, then we need to see if it is a business which has some entrance barriers, that has quality with high ROC, and it needs to have a good upside because we invest in value. And I would say that as of today, it is difficult for a company that has an upside of less than 100% to be included in our portfolio. It would have to be a company of an extraordinary quality, and the financial situation of the company needs to be healthy. They need to have a reasonable P&L account, and the managers need to be good in the day-to-day, and they have to allocate capital correctly. If the company fulfills all of these requirements, because in the end it's difficult to find a perfect company, then we will create a basic model or template where we will have the ROC yield, the background of the company with its historic records, and then we would also calculate the intrinsic value of the company. And comparing all of these things with the portfolio that we have at the time, then we individually would consider whether it be worth it to keep on studying, keep on researching, and if not, we would just add it to our research list. But if we think it is a valuable idea, then we would have to have a detailed story with all the KPIs that they have in the business, and then we would have a full-on study and robust study of the company. So all of these things, this first stage is individual. Obviously, the person who finds the idea would carry out all of these steps. And once that person has a fuller idea of the company, then they would share it with everyone else in the team. So during the first stage, we have to put everything in common with Paco usually and with other people in the team, depending on the availability of each of us and the expertise that we each have in different sectors. And amongst this group of people, there would be an informal debate. And if we think that it doesn't make sense to keep on studying that company because it doesn't add value to the portfolio, we would add it to the watch list, the team's watch list, and I will explain what that means later on. And if we think that the company could add value to the portfolio, then we would dig deeper. And that's the phase that we spend more time in, and that is where we really add value, and that is the core of what we do, which is the detailed study of the different companies. And this phase actually does not end here. It is a constant ongoing phase. We're always looking into the companies and looking at everything that we find out about those companies. And in this phase, we talk to all sorts of experts on the sector, the company, with analysts. We talk to the company, obviously, and we often talk to the CFO, to the CEO before we actually buy some shares. We analyze all the risks that could impact the company, all of the known risks, obviously. And then we would analyze the scenarios where we think we could find ourselves later on. And once we have studied that in depth, we would have, again, a debate, because as I said, it's not necessarily a strict protocol. It's not always exactly these phases. And we have to vote on it, and if the majority thinks that the company does not add value, we would add it to the watch list, the team's watch list, because all of these companies that we do not choose will not be forgotten. They will be included in our evaluation matrix, and we would have to follow up on them in case the circumstances change. If we do think that it could add value, in that case, we would take that idea to what we call the investment committee, which sounds very pompous, but it's just a meeting with all the team members where we usually have one every month, every 2 months, depending on how many ideas we've been considering. During those meetings, we study 2 to 3 ideas maximum, because we don't want them to be very tedious and we don't want to get bored. And in the end, long meetings don't make much sense, do they? And we always send the thesis beforehand so that everyone in the team has time enough to look at the model and make their mind about it, so that the debate is actually more efficient. So we would then present the thesis, because everyone has already had the chance to look into the company. Then we will each ask the questions that we might find relevant, and we would have a debate on the thesis and whether it is a good idea to include it in the portfolio or not. And at the end of the meeting, we all vote, and if there isn't a majority for or against, it would go straight to the watch list. And if we all think we should include it, it would be included in portfolio at the beginning with a small position. And as we get to better know the company with time and we become more convinced, then we would increase our position. And that is the decision-making process to include new companies. Now, as for how we build our portfolio in general, the concentration criteria are the ones that we have always mentioned. So the presence of a company depends on the knowledge we have on that company. That will increase with time. I think that currently it is difficult for a company that we have been following for less than 6 months to represent more than 1% of our portfolio. And that way we try to minimize the possibility of making mistakes. And then the quality of the business, of course, it has to high ROC and have entrance barriers. As value investors, we need to have a revaluation potential, so an upside potential. We have to have the highest safety margin possible. Then the balance and cash flow situation of the company, if they have a higher debt, it should be linked to projects or certain assets. And lastly, the corporate governance. That would include both the management team and capital allocation, and also the shareholder structure. As Paco said previously, we tend to have a certain bias towards companies that have an owner or where the top management has shares, or family companies. It doesn't mean that we do not invest in companies that don't have an owner, but we always prefer those companies where there is a shareholder who owns the majority of the shares. So we have an internal valuation matrix, and we include all the different ideas, all of the different companies that we have decided not to include in the portfolio, and all the companies that we have in our portfolio. So in this matrix that is usually updated on a weekly basis, we have quantitative information, ROC, yield, upside, and many other figures, but mainly those three. And with that information and with all of the qualitative information and considering the concentration criteria that I have just mentioned, then we make our decisions on a daily basis, our investment decisions. So in general, what Paco said previously, when companies fall, we buy, and when companies go up, we reduce our weight on those companies. But we have to understand that we sell when the price is close to the objective price. The share price is close to the objective, and we buy when the share is getting far from the price of the share is getting far from the objective. So that is how we update our position. And these decisions in general, and I know that these figures are not math, but when it's minor decisions, such as less than 50 basis points, are the ones made by Paco together with the person who better knows the company. And if it is very small decisions, 5 to 10 basis points, that is Paco. And if it is over 50 basic points, then it's a decision that we all make together. It has to be a consensus, but we don't have daily investment committees or weekly committees. It is much more spontaneous than that. It is quite dynamic, and we can just make the decision when we're in a room together. We can just talk about it, or via email. It's all quite agile. And out of those decisions, obviously, we get some liquidity, and we decide if we invested in new investment ideas with the criteria that we were mentioning previously, or in companies that are already in our portfolio. And that would be the summary of this process. And now Juan will give you a concrete example that we had in the portfolio. That is Maire Tecnimont. Okay, thank you so much, and good afternoon, everyone. We're going to try and illustrate this process, this investment process that Carmen has already explained with a practical example. So we're going to talk about Maire Tecnimont, which is a company that has been in the portfolio for the last 6 years. We have only talked about them in a couple of forums, in some conferences, and quarterly newsletter. We And for those of you who are not familiar with the company, Maire Tecnimont, in just a few brushstrokes, is an Italian company that is leader in engineering, design, and construction of plants in the sector of refineries, petrochemicals, and fertilizers. So how are we going to carry out this exercise? Well, first of all, we're going to be focusing on 3 variables, which are the evolution of the share price of Maire Tecnimont since December 2018. So during the last 6 months, the evolution of the objective price, our estimated value for the company during that same period of time, and how the weight of Maire Tecnimont has evolved in our portfolio during that time. So following the roadmap that Carmen has explained, so we're going to explain all of that in practical terms. So the idea was the value chain, and why did we have great knowledge of the value chain in Maire Tecnimont when we invested in it in December 2018? Well, due to 3 reasons mainly. First, because we had been shareholders in the past within Cobas in 2017 when we launched our funds. In our international fund, we invested in Maire Tecnimont, but they were their shares went up quite quickly, so that upside potential was reduced, so we decided to sell. And we had also been shareholders in previous stages in Maire Tecnimont, so I think that the company, we had known it for 10 years back on me, or even longer than that. And the third reason was that we had analyzed in detail our competitors, because we had we were shareholders in the competitors such as Técnicas Reunidas, which is one of the main competitors of Maire Tecnimont, one of the main investments that we have in our Iberian portfolio, and we knew their main clients as well. So the clients that were at the end of the value chain, so exploration or production companies or fertilizing companies such as ICL. So we really knew the largest spectrum, we could say. So as I said, after having invested in Maire Tecnimont and selling, the price had gone down, and we had worked in the company, so the price was at €3, and after updating the model, leveraging on that work that had already been carried out, we estimated that it was actually worth €6.5. So it was an upside of over 100%. So that is what triggered the decision. Obviously, we fulfilled all of the requirements that Carmen mentioned. It was a business that we understood within our expertise, because we had been shareholders. It had a net cash flow, which is actually very important, and this is a cyclic company with entrance barriers that were quite clear to us, basically based on the fact that they had some technological patents that were very difficult to replicate. It's almost impossible to replicate. And secondly, they were operating in an oligopoly with very few competitors, so we knew that it was very difficult for someone new to arrive there and find their spot in the sector. And the upside was 100%. A good management team with whom we had a very good relationship, because we had been shareholders, we had been with them, they had come to Madrid, we had gone to meetings together. And lastly, but not least important, we had a term visibility with regards to cash flow generation, which was quite high. So that gave us a very, very high comfort level. So the decision at the time, says the speaker, so the decision was quite fast. It took us a couple of weeks because of what Carmen was saying previously, because it's a sector that is not new, it's not peripheral, we already knew it. And it was a decision that we made out of consensus. The gray bar that shows the load, when we made the decision during the first 3 months, we had a 1% position in our portfolio with Maire Tecnimont shares. So what happened later on? Following the thread of this process, so the share went from €3 to 1.5, so almost 50% drop in just 1.5 years. But as we can see in the light green line, our target price was quite stable, so we had a greater upside. So we actively decided to increase our position in the company and reduce the average acquisition price, as you can see on the slide. And I'm not going to repeat that. That is what we kept on doing. We checked that the concentration criteria were met to increase our weight with this company. So we knew them for many years. There was a attractive potential potential there, and the risks were reduced. And I also want to say here that the concentration was took place due to two reasons. First of all, when the price was falling, we purchased shares, so the price went upwards. But then in 2020, there was another factor. Midas shares went up. So we saw that it went from 1.5 to over 3. So it doubled in less than a year. And at that time, although the rest of the portfolio during COVID, everything was going upwards, that of Midas was growing even more. So its weight was increasing. And that is when we see that it gets to this maximum weight. I don't know if you can see it in the slide of 5.5%, which was the weight that Maire Tecnimont had in our portfolio at the time. And here we see the end of the story, but we have to highlight certain important steps and that Carmen has described. So when the share price went up from December 20 and December 2021 in an abrupt and fast way, but the target price was still stable, obviously the upside potential was reduced. So not automatically, but almost automatically, we decided to sell our shares and reduce our weight. We always have a problem with time, so you know that we try to do it in an optimized way to try and extract as much value as we can when we sell the shares. And the other side of the coin was when in December 2021, when we saw a fall in the prices, and it was around from 4 to 2. It fell 50% in a company that we knew very well due to the fact that it's quite cyclical. This was due to market fears, but we did not give them much weight. So the price went down. The target price was still stable, so our upside went up. So we decided to buy more shares. And that is when we went from 3.5% to around 4.5 to 5%. And that is how we reached the end of the road, which was deciding to sell all of the shares of the company with that last drop that I explained during the next 1.5 years, 6 semesters. The shares went from 2.5 to 7.5, which is the situation currently. So clearly, with a 200% increase, we saw that the upside potential was less than that of the aggregate of the portfolio. So in an active way, the team decided to sell progressively all of its shares until the beginning of this year, and now we have no shares of Maire Tecnimont, and that is one of the companies that Paco has shown. It's the last one that showed that there was a 91% upside that has been completely sold. And this is the last point, really. So obviously, companies are dynamic animals, so they will not always have the same value. So if they do things and they do them well, they will see an increase in their value, and that is what happened with Maire Tecnimont. But if the price goes upwards faster than the target price, then you don't have an upside possibility, and that is when we reduce. So in a dynamic way, that is what we do with this practical example. We see it very well, but what we do in aggregate manner, always in our process, is see how we can increase that line that we have shown very often, which is the target price. So some of them go up and they close the upside, so we reinvest in more attractive companies, new ones, or those that were in the portfolio that have gone down. And finally, we have to say that price and value sometimes meet, and we could say that price and value almost never touch. They tend to get closer, but they never touch due to the reason that I just mentioned. But it's important to mention one last thing, which is the fact that we, with this black line, 6 years ago, we did a value estimation that was from 3.5 to 7 euros, and it was stable for 6 years. And eventually, the price of the company has actually reached that level. So it's not that our target price is an exact science, but we do dedicate much time to calculating it, so as we try to explain. And most times, the companies and the values of the companies that we invest in do get to those target values. And I finish with this, and I will give the floor to my colleague, who's going to now explain the situation with CK Hutchinson. Before we begin, I would like to say that Minkun is going to be doing this presentation in English. He will be speaking slowly, and I will summarize what he has said for those of you who do not speak English. But in any case, you can always listen to the presentation with subtitles later on, because we will upload it on our website. So if you're interested, you can always do that.
CK Hutchison. Let's see how is the profit, where is the profit coming from for this very complicated company. So first, if you see on the green part, 50% more or less profit coming from Europe here. And then the next one is 23% more or less coming from Asia, Australia, and others. And this Asia is not including China and Hong Kong. And then the next one, almost 20%. This is their equity investment that is not counted by region. So what are those? There are a couple important business here. So first of all, it's their stake in Cenovus. This is like a Repsol in Canada, the #1 integrated energy producer in Canada. And then the other one is their 5% stake in Cellnex, which is a European tower company, also listed in Madrid, Spain. They got this because in a process, they sell their tower business to Cellnex. And the other one is Indonesian mobile operator. They are the #2 market share owner in Indonesia, a big country. So this is the equity investment part. And then the China and Hong Kong, in combined, they account for less than 10% of the profit. And if you look at the business, so where is the profit coming from by business? So the two largest business on the right-hand side, the green one, infrastructure and telecom. In combined, they are a little bit more than 50%. And the next one is the equity investment. And there's two smaller ones, which is retail and ports business. We are going to expand them in more detail in the following slides, so no worry. But before we go into more detail, I would like you to remember 2 points from here. #1, Hong Kong and China is less than 10% of the profit of the company. And secondly, And secondly, there's no single business accounted for more than 30% of the company. So it's a very diversified business and in over the globe. So moving to the next one, let's talk about a business. So CKH is the operator of power and gas network and water utility, majorly in UK and Australia. So if you look at the map here, the green part is where they have a business. And there are 2 things I would like to highlight. So #1, you see UK is almost 50% of profit. Australia, New Zealand, the other 25 to 30%. So majority of the profit is coming from the country that has a good rule of laws. And these are the utility business, the regulated business. So the business is very stable and very predictable. And the second point I want to make here is, if you see what they own in this country, it's majorly power networks, gas network, water utility, and these provide a very important growth angle for the company in the coming years. Because in the era of energy transition, the country around the world will have to probably invest a lot in energy infrastructure. And this is mainly owned by CKH in those countries. And next one, the telecom business. Again, if we look at the map here, let's talk about UK, which is the major contribution, well, one of the biggest contribution for the business. So they own 100% stake in UK, and they have about 10 to 11 million subscribers of the mobile service, and they have 14% of market share in UK mobile market, and they are the #4 players, and they are in the process to merge with the #3 players, which is Vodafone, And if success, they will become the #1 players in UK market. And with all these numbers, you probably will get a good idea that they are very serious players in Europe telecom business. And retail. So CKH is actually the world's largest international health and beauty retailers. And this is the brands they operate. So if you see this graph here, the map, so basically they are operating about 16,000 stores among the globe, mainly in Europe and Asia, roughly half. Europe, 8,000 stores in this country with this brand. So you probably will see Superdrug in UK, Rossmann in Germany, for example. And in Asia, the other almost 8,000 stores, majority is under the Watsons brand. They have about 160 million loyalty members. That's a huge number here. So the last business here we talk about is the port network, the container shipping port. So, sorry, back here. So in order to give you an idea, they have a very comprehensive port network. We can look at this chart. So they have about 53 ports in the world and about 10% of global throughput share. So what does that mean is that imagine 1 out of 10 container box coming to a container port. One is handled by CKH. So this is the market share in the container box business. And then if you have a list of the top 10 busiest ports in the world, then CKH has terminal in 5 out of those 10. So this gives you an idea, they have a very comprehensive network in the world, in the port business. So moving to the next one. So look at the green line here. This is the book value per share. So despite the fact they are paying dividend every year, the return earnings and book value per share has been growing throughout the year in the last decades. And we credit this to the family behind the company. They still own 30% of the company, and they have this incredible value creation history that in their hand. And however, if you look at the share price, it tells a very different story. So it's coming from 100 per share roughly, 2015. Now it's trading about 40 per share in 2024. So it's amazing. And why is that? So basically, we try to think why is the case. The simple one will be holding company discount. As always, the analysts like to put the discount to this kind of holding company. Of course, we do too, but not to the extent of 50% or 60%. That just doesn't make sense. And then secondly, I think it's interesting. Despite, remember I told you in the first slide, remember that less than 10% of the profit is coming from Hong Kong and China. This company is quoted and listed in Hong Kong and is covered by Hong Kongese analysts, who is very far away from Europe. So 50% of the profit is just there, you know, and they are more familiar with Hong Kong and China. So it's just this match in the information, for example. And secondly, they have a very complicated business. So it's very unlikely one analyst will be able to understand all the business in detail. So most likely, you know, they pick the biggest business and then put a valuation of that industry, and that's it. So there is a mismatch in the information. And in addition to that, recently in the last 1 year, I think the Hong Kong market became an orphan market as a result of this China and US tension that caused many international investors to leave Hong Kong market. So this created opportunity for us actually to buy some decent business at a reasonable price in Hong Kong. And the next one, so the exposure in the European telecom industry. Remember I told you they have no single business more than 30%, right? And so back to 2019, they did the merge in Italy that to merge with a Win, and then that increased their telecom exposure. So it's increased to in one point to 35-36%. And the European telecom business in the last decade is not, it's not the best business in the world. So the analysts, try to see them as a telecom business, and then as a result, it's not a very welcome result for that. And also, UK Brexit, as you remember, they have exposure in the UK infrastructure business. So this is also is a negative to them. However, what can change? So the basic thing in this scenario we see is to buy back. So for the family to buy back the share at a discount and close the discount of the company. And as a recent example is in 2021, they sell the European tower business to Cellnex at a very high multiple, I think more than 10 times EV/EBITDA. And then so majority of that proceeds is used to reduce the debt, but they use part of the cash to buy back share. So I think they are doing the right thing. And in face of this Hong Kong being an orphan market, I think it's important to raise the fact the company is actually incorporated in Cayman Island. So if they want to change their listing place, or they could do it, it's not very difficult. And the last point here is there are more opportunity. They can monetizing their business, perhaps to do buyback. Before COVID, they were talking about IPO the retail business. And due to the COVID, this plan was kind of stopped. But after normalized year now, we can see perhaps this could be coming back to the table. So that's it. With this, I hand back to Paco.
Voy a hacer un breve resumen de para los que no sepáis inglés. Básicamente es un conglomerado.
Well, here we're basically talking about a conglomerate owned by a Hong Kong family that have 30% of the business. Is a diversified one with several activities, telecoms, infrastructures, power infrastructures, water infrastructures, like Spanish Red Eléctrica, but in the UK and Australia, they have the greatest chain of beauty and health retail stores. Half of them are in Europe, half of them are in Asia, and they're the largest port owner across the globe with different activities. All of them, you know that transactions in the private market are very high across all the different industries, and there's a specificity to this, as Menkun explained. While the book value increases every year after paying a substantial dividend, the stock price is in a 25-year low, actually. It's indeed the lowest price in 25 years. That's their stock price, and there's no reason behind this, and this is why we have increased our stakes there. And let us move on to the conclusions before we move on to the Q&A. It's obvious that there's a great potential for revaluation, and we continue to do work for that potential to continue to increase, or at least for it to not decrease, as Juan explained when he was talking about Mer de Nimont. And we have indeed a team that, as we have explained, has been working together for a very long time. We have a long track record of working together, and we have fine-tuned the way in which we work, and there's very little to continue to hone in the short term, I'd say. So all in all, after 7 years at Cobas, our average time for the different companies is 5.7 years in average in our main positions. Some companies, of course, have been sold and some others have been retained. But as Carmen really explained, time helps us fine-tune our approach to companies in terms of enhances our knowledge. We can do our analysis in 2 or 3 months, of course, but staying with them over the years allows you to have, let's say, a cover of knowledge in which you actually really get to know all the different points, and well, this is something that perhaps we lacked in the beginning at Cobas, but this is something that has been fine-tuned now, and it's really difficult for us to really make mistakes with these companies that we have been with for 5 or 7 years. We may make mistakes, of course, but this might be minor and not have that big of an impact. And this is something that we have said many times. Actually, as we explained on the slide that I spoke on, portfolios apply to any market environment. And actually, from 2000 to 2022, we had a drop of 40% in markets, but our funds, the Iberian and international funds increase and improve their position. It's an 80% different. And it's very important to perform well when markets are dropping. And the foundation for this is indeed that we're working with companies that are purchased at 6 times profit. So the market could drop from 15 to 12, 25% decrease, and we will go from 6 to 9, and it's a 50% increase. This can perfectly happen, and it's normally what indeed happens, as we explained when we were talking about the long run. There are successional moments, one-offs, when negative things happen, but these are time series. And with this, we're almost done. It was a bit over an hour, and now we have time for Q&A. I don't know how this is going to be organized. Please go ahead and let us know. Well, thank you. We are now going to begin with our Q&A, but before we get started, we would like to thank the more than 1,000 people that are viewing us live, both face-to-face as well as online. We have received more than 100 questions, and we would like to try and answer as many as we can from now until 8. And those that will not be answered today, the investor relations team will reach out to those that ask them to provide an answer. So we have a first question about Elecnor, a company that made a great contribution to our Iberian portfolio last years. They increased, the stock increased by 30%. And they're asking us how, in spite of that increase, it's still one of our main positions. Well, the short answer would be that the revaluation potential is still very high. And in this case, Elecnor does deserve a long answer, because Elecnor is a long-standing company, a classic in our portfolio. And it's a company that we've known for more than 20 years, in my case, but more than 30 in Paco's case. And our knowledge has really helped us, how should I put it, come up with the right valuation of the 3 businesses, because they work with the renewables, transmission lines, and engineering. And actually, our assessment has enabled us to invest in Elecnor since Cobas was launched. Share prices were at 10, 12 euros for a few years, and as you mentioned, last year it rose up by 90%, reaching 20 or 21 euros, which is a current share price. And why? Well, to put it simply, they sold the renewables department or division by an amount net of debt, net of tax of 15 euros per share. It was listed at 10 euros, 12, but that one division was sold at 15 euros. And to those 15 euros, you need to add the other 2 divisions. APG, their partner, well, for those of you that don't know them, is a very large fund in Europe. Well, 5 years ago, they valuated the transmission line division in approximately 7 euros per share. This was approximately for 5 years, but the company continued to grow. So let's stick with that. 7 euros plus 15 euros in renewables, it's 22 euros per share. So you would have the engineering division free of charge. And what does the engineering division do? Well, they do all sorts of things, but importantly for the valuation, they generate around 200 million in EBITDA. And actually 3 years ago, there was a transaction in this sector by which ACS sold their engineering division. It's very similar to what Elecnor does at 6-9 times EBITDA. The analyst consensus focuses on 6 or 7, but it doesn't really matter the multiple that we choose. It's clear that Elecnor is worth much more than those 20 euros that it's listed at right now. 2021 euros, because if we were to focus on the 6-7 euros that the analyst consensus uses, that would be 15 euros per share. So the potential is clear in spite of what happened last year, and this is why we retain it in our portfolio. Thank you. Before we move on to the next question, for those of you in the room, you can use a QR, but also you can get a card from a hostess. They will hand you a card and a pen so that you can ask your person in writing if you will. Vicente, they're also asking us about the pharma industry. We explained that we have reduced our exposure in the power industry to give more weight to the pharma industry. So they're asking us in particular what companies we're focusing on in this industry. Well, good afternoon, everyone. Thanks for the question. In the pharma industry, we basically have the same companies as we did last year. Fresenius, the International Fund, Organon, also Teva, Beatrix, and this year we added a new one, which is Bayern, which is not strictly a pharma company, but also a farming or agricultural company. And they create seeds and products for crops. This is the last inclusion. And there was a takeover bid last year. We had a small position in Italo Pharma, and we sold that, and we have reduced our exposure in Teva because they perform quite well, and we improve or increase our position in the Fresenius that performed badly, and we got Bayer in too. The pharma business is 40% for Bayer, the agriculture business is approximately 50%, and then the consumer business, focusing on health, amounts to 10%. In one of the previous charts, we saw that they performed badly. They had accumulated decrease of 70%. We know the worst cases and the concerns of the market that are basically focusing on the loss of patents in the pharma industry. But of course, that's factored into our calculations. They're going to be losing about 20% of the profit for that division. And they also have some issues with litigations because they had a historical acquisition from Monsanto. We factored that into, and we're additionally more conservative, adding more provisions because we know that in case of litigation there could be unknowns to come. So we added more uncertainties to Bayern in terms of provision, and we know that it's listed at 6 times profit. But if you focus on the comparables, for instance, in the agriculture business, the comparable is Corteva, and they are 2025 PER. In consumption, the comparables are at 15.25 times, on average 20, and in pharma, I think that it's a multiple of 15-17 times. And in this case, because this company will be losing patents, they probably don't deserve that 10 or 15 multiple. So we apply a profit multiple of 10 times, which is more conservative to reflect the uncertainties. So blended, it would be 15 PER, and it's listed at 6 times profit. So it's an interesting opportunity, and this is why it's in our portfolio now. And for the rest, what we do is those that perform well, we sell them and rotate them for those that are not performing so well. Carmen explained earlier on our investor process. We sell those things that perform well and buy those things that perform badly, unless there's a change in the valuation of the company, and that's roughly what we do. Juan Cantus, we've seen that the weight in area defense has increased. We've talked about Babcock many times, but we didn't talk about Avio. So an investor wants to know about the thesis behind this company. They're also asking about the current conflict between the EU and Russia, whether there's some sort of implication for this company. Well, Avio is a company that I very much like, so let's talk about the basics exclusively, because otherwise I will be too long-winded. Avio is an Italian company that produces rockets and the propulsion system for rockets for the European Space Agency. And in the past, the agency had the support of Russia, but now, due to obvious reasons, they don't. And this actually implies that there will be more activity for European companies, amongst them Avio. And due to this, the number of engineers at Avio has been doubled. And this is important because these companies in these industries where manpower is key, well, that's actually a very relevant piece of information. And something that we need to mention in the context of Russia is that those same capacities that make it possible to launch a rocket, to place a satellite in the exact point of the orbit that you are aiming at so that a satellite can do what it intends to do, and these are engineering works that cost billions sometimes. Well, those same capacities allow them to intercept other missiles, drones, or planes, and that is essential. That saves very many lives, and this is why the demand for missiles is multiplying, amongst other reasons, because Europe is running out of missiles for its air defense. And it could happen, as it's happening in other contexts. The question is out there: what would happen if the war came to an end? There would be such a high stock of strategic inventories that we would make those last beyond 2030 with the current resources. Now, missile propulsion systems also have margins that are double of what is normal in the purely space industry. So in just a few years, Avio's profit will exceed the historical maximums if there's no big surprises. And with the stock price at low levels, we can estimate that yields, profitability will be really attractive. That is to say, that there will be growth for rockets, for missiles, and additional margins.
Huerta por BW Group.
Juan Huerta is asking us about VW Group. There was an attempt to restructure the group a few months ago. As he says, that if it's not wrong, this is part of our international portfolio. So they're asking us whether you could provide more information about this, and what is your opinion about this? What are the main strengths of this group and the subsidiaries, and the potential for value creation? In our international portfolio, we have two companies of the VW Group, which is an Asian group, and they own several businesses, and some of them do exploration and production, and another one is floating structures for oil storage. And they have SPFOs, and they also have VW Energy, which is an operations company with assets in Gabon, Brazil, and Namibia. And I don't know if you've heard, and this is the new border where there could be new growth for oil production. Now, the question is in particular focuses on the restructuring. Well, between VW Energy and VW Offshore, the boat company, they had some cross shares. VW Offshore owned 25% approximately of VW Energy. So what happened at that point in time was that the VW Offshore sold the stakes that they had in the energy company to the holding, to the parent company, which is VW Group. So they became the majority shareholder, and now they have more than 75%, almost 80% of VW Energy. Now, it's a bit cumbersome to explain, but what is perhaps most important for investors is that these are two companies that have a relevant weight in the portfolio. The business that they are in, that I explained, are really relevant, and the stock price we don't think makes any sense. We try and find a logic between Paco and myself and the rest of the team, but there's a lot of room for cash generation. I don't want to go into more detail because otherwise I would take too long. Actually, when I was in Singapore, I visited 2 boats of VW offshore. One of them is almost finished. Another one is being revamped for a Turkish company. This is a very clear example of a company that's listed at the stock market for a low price. It's actually less than $600 million, and they said that this year their EBITDA will be 300 million. So they're at 2 times EBITDA. They have no debt. They're operating at net cash, and the boats look really good. These are new boats that are going to be contributing to the EBITDA, so not bad at all. And with mid and long-term contracts, indeed, that's the case. We have several questions about the sensitivity of our portfolio to interest rates and the alleged interest rate drops that we could see going forward. Also, wondering whether this could impact further these companies that are on the growth path. And they are also asking whether the sweet moment for value investment could be impacted. So all in all, it's whether we're sensitive to interest rates and if growth companies versus value companies could perform better, or if it's the right time for value investing. Well, this happened a couple of years ago in 2022. The increase in interest rates caught everyone by surprise, and growth companies suffered more than those that are more affordable. And if something's listed at 20 times profit compared to something that's listed at 6 times profit, the suffering is not the same. When you do your discounts, the interest rate instead of being 2, it could be 6, so it loses more value. So this was the case in 2022. Will interest rates go down? We don't know. Will they increase? Well, we don't know. There's a natural trend to go towards to generate inflation. Otherwise, the public debt is not repaid. I don't know whether interest rates will drop, and that's not really relevant for us. Those companies that have some debt in their portfolio, they will benefit from a decrease, but it's just a few of them, so it's really not that important for us. And those that have a lot of cash, and we have several of those, they will benefit in an interest rate increase environment. Daniele called us up, and they have 1 million in a current account, and this year they had 50. And last year it was 0. Some people will benefit from this, and some other people will be punished. But it's not essential for us. Actually, when rates were at 6%, 0% in our float discounts, we always assumed 5%, never 0%, because it seemed absurd. And we performed our sensitivity analysis considering that they would be at 5. They're at 5 in the US and at 3 in the EU. So we'll see what happens. And we don't think it's really something that is relevant for us. As I said in the beginning, with normal growth of global GDP and normal interest rates, well, that's what we work with, and movements could impact one way or another in an unpredictable manner. And as I mentioned in the beginning, what really matters is how we react in the face of things. Foreseeing things is almost impossible. Paco, we have received several questions about the closing of our funds, whether we're close to that closing, actually. And an investor would like to ask whether it would be possible that they would just limit the contribution to minor shareholders instead of closing the fund. That's a good idea. We hadn't thought of it. We will take that into account. Well, obviously, we should be thinking about closing the fund. And if we think that the fund is worth double of what we're managing, we are managing 4.4 billion, and that's the reality, and we strongly believe in this. And if we are coherent, we should do that, but we will see. For the 2 basic portfolios, the international and the Iberia portfolio, the limit will be 4 or 5 billion, and that'll be the limit. We are no longer analyzing companies of 200 or 250 million. We had to rule out some of them because otherwise, well, you need to buy 10% of the company to have 1% in the fund, so it doesn't really make a lot of sense. So if we go to 4 billion, that we will, we will have to get rid of companies that are at less than 500 million. And what we like is to provide value and to enjoy the work that we do. So if you have to get rid of those companies that provide more value, which are medium-sized companies, then it wouldn't make sense. I mean, we'll keep our word. Carmen, they're asking us about Currys. The company is still open to a takeover bid after what happened a few months ago. And now about the share price. Is it possible for it to continue to increase based on the positive performance that it had in the past? And what about if a crisis would hit? Well, Currys is a position that we have explained many times. It's an electronics retailer in the UK and the Nordics. They recently lost their Greece business. The company has actually received 2 offers this year. There was interest shown by the Chinese giant JD.com, and then there was another 2 offers that were way below our valuation of the company, way below what the management and the board of the company think that Currys is worth. Could it be open to a takeover bid? Well, it could. In the United Kingdom, there's a lot of acquisition activity because it's actually a very punished market, and it's still open to takeover bids. We are reassured because after speaking to the company, they made it clear to us that these offers, they wouldn't even entertain them. They wouldn't even consider going for such an offer. And the share price, they have a relevant weight for us, and we think that there's a lot of potential for them still. In the last year, they revaluated by more than 20%, but they're coming from very significant drops. So the gap between the price and the value is still very large, and we think that it continues to have good perspectives. And the business has increasingly better perspectives. The latest results have been quite good. The guidance has been improving, and there's tailwinds, and we think that we will have good news going forward. They're also asking us about the increasing commodity prices. So what do you think about gold, copper, and silver? Well, those commodities, we just take them as they come. It's impossible to ascertain and to foresee the price of commodities. Supply and demand change, and only the value of the commodity increases. In some cases, we may have some knowledge about them, as so happens with oil. And when we think of a price and we buy companies at those prices, and the price for oil, the reference price for oil is $65. And at that price, if some companies generated relevant cash and it's discounted by the market, then we're interested. But these are very specific cases, very special cases. For some other commodities, for some other raw materials, we tread lightly, and if we find value, as for instance Atalaya and copper, then we bought Atalaya. They're listed in Cyprus. They're from there, and they have mines in Spain, and the management team is in Spain. Who buys that? Well, we buy that because we understand why it's undervalued with a reasonable copper price. But we are not intending to tell the price of copper, actually. So we have some copper companies, some gold companies, some oil companies that are undervalued in normal conditions. And at the end of the day, those raw materials are commodities. They're commodities, and the price is stated by the market, and there's very little room for negotiation. So we're not agnostic here. We'd rather be company investors or shareholders, because the commodities and companies at the end of the day provide the same service. They fend you off inflation. We have some companies in the portfolio that sell bread, and they adjust the price of inflation anyway, so that shouldn't be a problem at all.
Now, with regards to Vocento, maybe you could answer that question. There are 4 to 5 questions Andoni is asking in a context where the press is facing a structural problem and the marginal business areas are not safe. then why has Cobas chosen Vocento, and we have such a firm bet on them? And then there's another question: do we consider that this is a share with quality at a low price, or a share at a low to medium quality but with a very low price? And what are the catalysts in the share? I'm sorry, what? Yes, for the company. What are the catalysts that we consider are present in this company, and if it is generating free cash flow? If it is a share that is of quality at a low price, or a share of a medium to low quality but at a very low price. What catalysts? I'm going to start with the last one, because last year, I think it was, they asked me that in this forum, when would the shares start rising? And I said that when the diversification business, especially the one with classified, starts delivering the return on the EBITDA. And the share has gone up from 55 cents to 80 something cents, 90 cents now, thanks to the fact that the profit made, or the EBITDA rather, of the diversified business is becoming more important. It represented 30 to 35% last year of the total business of Vocento, and I believe that that confirms our thesis. Vocento is not just a newspaper. It's not just newspapers. And in newspapers, it's true that paper has gone down from a structural point of view, but the news have to still be known. I mean, it's the fourth power in any democracy. And Vocento, I think I've said it previously in this forum, is the one that has made most progress with digital ads, subscriptions included. And we think that the digital side of things is going to compensate, and has almost compensated the drop in paper. And quality businesses, well, the diversified part, the most important part is classified, so ads. And Davinta has just been taken over, and they are the main European leader in online ads. I mean, online classifieds, it was 20 times EBITDA, I believe. And we obviously don't use those multiples. Idealista has just been purchased, and it is now for sale. And the last time it was sold, it was 30 times EBITDA. So that means that these are good businesses. If we just look at the paper newspaper, well, it doesn't represent as much as it used to, and especially the national newspapers. But if we look at local newspapers, I think that they have a very good brand image in all of the places where they're geographically set. So I think it's good, or even very good, with regards to quality. Why would we invest in a sector with low margins? And they're referring to the automotive sector with high competition, with low certainty. They're referring to the switch to e-vehicles. That's a very good question, yes, and we actually wonder about that quite often. But in the end, the exposure that we currently have is only 3.5%. It's a small exposure, and these are exceptional situations. And the companies that we invest in, well, with the discounts that they have, they're quite powerful. They're quite solid. And it's true that they have low margins, but the return on capital is not that low. Automotive companies, what they do is they assemble. They design, they assemble. That is what they do. So the capital invested is not that high. They generate lots of cash flow, and in the end, the market does not value that cash as they should, and that's the case with some companies. So it seems to be a complicated sector, and it is a complicated sector, and we have to be careful with the exposure. But we think that the exposure that we have is not high enough for us to be worried, especially in special situations. It's like what we said about commodities. These are special situation. Is like Porsche's holding, like Hyundai. So these are special situations, and it's not the automotive sector we're buying in. We're buying special situations within the sector. I don't know if you would like to add something, Juan, because you are an expert in the sector. Well, no, I would say that they're also mentioning e-vehicles here. Yes, there is much uncertainty. That's true, but on both on both sides, because it seems to be slowing down the sale of e-vehicles, and as of today, at these prices, consumers are not willing to buy. So some interesting companies, as Paco was saying, these are very specific cases that are currently having their shares valued at 2-3 times their profit. So if the e-vehicles are delayed, and this companies have not been investing in the traditional cars, then they could maybe make much more money during the next few years when they are actually being listed at 2-3 times profit. So although because now people are still buying traditional cars and not electric cars, so it's an interesting situation. They're still generating lots of cash flow, and in 10 years time, well, we'll see. Right now their shares are very, very low, so thinking about 10 years time, it doesn't really deserve our effort, because it's too.
Nos preguntan de la parte de la cartera de Asia.
We are being asked with regards to the Asian portfolio what percentage we have in Japan and what companies do we like in Japan.
I think we have about 3 to 4%. Couple company, Okamoto, Taiwan Industry, Ichigo. I think that's it. 3 of them. You want me to go detail to explain them?
Well, as you like. Maybe just a bit more.
Yeah. So we have 3 investment in Japan. Maybe we from Okamoto. Okamoto is again is family owned as usual, and net cash position. And the big part of the business is actually content business that is very stable. And they are number 1 share in Japan, and they are number 2 or 3 in China and Southeast Asia, where the growth will be coming from. So that's again a very stable and predictable business. And the other half of the business is coming from the industrial. So there are many things. For example, the autos, seats, skin, etc. But I think the key here is, last year we went to Japan. Paco and I visit the company, and we are very fortunate to have a chance to meet with the son of the founder. And so we like that person, I guess. So he has a mind of industrialist. He mentioned the companies for manufacturing, and then they have to do it for years, and they will just keep doing that. So that's Okamoto. And the other one, the second largest, I think, is Ichigo. So Ichigo is an auto parts company. They basically doing the auto lights business, the lights in front of the car. And the majority is owned by a French company called Valeo. So we like lighting business because this is one of the few businesses in auto that has number 1, the growth angle. Gradually compared to 5-10 years ago, your car has more light inside and also outside the window, and then the light is made very fancy, and that's important because OEM want to have fancy lights to attract consumers, and that's one of the few points they can do. And the other thing is lights, no matter it's a battery vehicle or ICE vehicle, you need a light. So there's zero technology risk in terms of that. So I think Ichigo provides us a growth driver in lights, and also they have, I think, 20 to 30% exposure from Southeast Asia and another growth of the auto market. And the last one is Taiwan Industry. I think we own this for a while, for a couple of years. The story is the same. They are making the commercial refrigerator in the kitchen, etc. And that's a very stable and very high ROCE business. And the other one is they have a net cash. The other day update is almost 90% of their market cap. So the rest of business is almost for free. So it's a net stock that we own in Japan. Yep.
Voy a traducir brevemente. Son 3 compañías.
I'm going to briefly translate this. So 3 companies, 2 of them are family owned, and Valeo is a French company that is, well, we actually met with them last week in Paris. They They have most of Ichigo's shares. All three have net cash situation. It doesn't matter the industry. What really is important in the stock is that situation. But they all have very good positions in Japan, but also in the rest of Asia, in China and Southeast Asia, with very interesting perspectives, all of them really. We have also received a couple questions from investors who are asking about uranium. How do we see that in the short to medium term now that Biden has forbidden to import uranium from Russia? How is Cobas going to play with the situation? Well, as Warren Buffett said, we are going to be spectators. Unless someone has a very, very strong conviction with regards to uranium, we will only be spectators. But uranium is a commodity, and it is the most opaque commodity that exists. We don't know what the stocks are, because with oil we know what the demand is, what the offer is. We know where the oil is. It's geolocalized. You know where oil is, but we know nothing about uranium. So investing in uranium, I think, is like a leap of faith, isn't it? It could work well, but it's like playing red or black in the roulette. It's 50-50. And now that you've talked about oil, we had a couple questions about our opinion on the oil sector and if we see any opportunities here in Spain or outside of Spain, besides those that are already in the portfolio. And that's basically it. Has anything changed in our vision of oil? Well, in Spain, there's Repsol, I think. I don't know if they mean that we're going to be drilling for oil. Well, that's the question. I don't know. I mean, Repsol is sometimes in our portfolio, sometimes it isn't. It just depends. We've been investors, and we could be investors once again. And outside of Spain as well. Yes, do we see any other opportunities outside? And then what is our thesis with regards to oil? Do we have anything new to add to what has already been said? Well, we've already said that $65 as a reference in the long term, that's our framework, and we do an estimate in each company with those pricing levels. What is the cash generation possibility, and when it is competitive compared with the rest of the fund or with other oil companies, then we buy. It's actually a pretty simple framework. So why do we use 65? Well, because we think it is the right price in the long term. Less than 65, you're not incentivizing for the production of oil, and over 65%, 75, 80, 90, that is not sustainable because there's enough oil, so more will be produced. So we could be wrong, but that is what we use. That is our frame of reference. And then we invest in companies that don't have much debt. That is the theoretical framework that we use to invest in oil. The advantage with oil is that there is lots and lots of information, and you can really have a general idea of what the costs are, production costs, and whether the price in the long term should be 65, 40, or 100. So that is why we have a certain exposure to oil exploration, which is 13%. We don't want to go up to 30% or 40%, but 12, 13% is all right. Juan, we are being asked about Técnicas Reunidas, the improvement in their shares. Could you explain to us what are the main factors that have allowed for that growth? What were the roles of the new contracts? Was it strategic changes or operational changes? Actually, Juan, there is another question saying, could you maybe Maire Tecnimont could be the new Técnicas Reunidas? That's what they say. Well, let's hope that's the case. Let's hope. Because if they multiply by 3 like Maire Tecnimont, it'd be great for a portfolio, wouldn't it? And yes, answering to your question, yes, the operational improvements that the company has put in place, well, especially the improvement in margin. Maire Tecnimont had a few years, and I think we've already explained that were pretty bad during COVID, and they were not just something that happened to Maire Tecnimont, but rather the whole industry, with a series of contracts that have been signed at a certain price, and then everything that came after COVID. They couldn't take the workers to their sites to put in place refinery facilities and so on. When we talk about these engineering projects that last 4 years, you're talking about 15,000 people working in a processing unit, gas processing unit at 50-degree weather in Dubai. So it's complicated, and COVID for them was even more complicated than the one that we might have suffered at home. I mean, having to have 15,000 people going from one place to the other, that affected the whole industry. And obviously these projects that had been signed at a certain cost had overcost in the end. But now going back to today, these projects only represent 20% of their projects, of their orders, and they have already had agreements and negotiations with clients that are paying an over cost, and they represent a lesser amount of their whole portfolio of projects, and now they have very attractive margins. So we do think that it is unavoidable that Técnicas Reunidas will improve their margins, which is what they said in Abu Dhabi during their Investors Day, where Paco and myself were present listening to them, and we actually took a helicopter to look at their 50-degree islands. We flew over them, and they said that they're going to generate more cash flow. That is the direct consequence of having better margins, and they will repay the debt that they took on with public entities, and they will start paying out dividends, which is what they had to do. And that could be compared to Maire Tecnimont. Actually, that's a very interesting question, because it's what Maire Tecnimont said in Milan when we were listening to them when we were shareholders, and they were doing what they had to do, and they were doing it right. I don't know if I have forgotten something, but basically that's it.
Vale, pues tenemos ahora a Golar.
And now they're asking us about Golar, our greatest position in the international portfolio. We have several questions about this. And one of the questions actually tackles the fact that large contracts are not materializing, and if they don't place the order, these big orders, the company says that they won't be able to deliver until 2027. So would you reconsider your position if this were to materialize? The next question is what will happen to Hilly, and the other question is about the owner of the company, whether you think he will sell. Well, we recently talked to the management team, and we're quite updated. They presented their results last week, and I think news could be considered positive. Do you want to speak about them? Yes, let me speak about the last question. We don't really know what they're going to do, but we don't think that they will sell. I was dining at Oslo with the owner, with a small team of investors, the CEOs of the different companies that make up the industrial holding, and I didn't get the impression that they want to sell. They're long-term investors, and they have an optimistic perspective on Golar's future. What will happen to Hilly and Golar's contract in general? Well, generally, what they said is that they have a unit, which is Hilly, that has been running uninterrupted since 2018, and it's the only unit in the world that has been running uninterrupted since 2018, working on liquefied natural gas and others. And this actually goes to show their experience as operators and developers of this project, because Hilly is a ship that they developed themselves. At the end of the contract, the contract is currently underway, and we think that they're very well positioned. We think that there's future projects in the horizon for liquefied gas, and being able to take that off the shell and putting that into work in 2007, that's certainly Hilly doing that. Other ones would have to go through the shipyard and have a 4 or 5 year delay in order for you to get a hold of those assets. So we think there's very good chances that they will continue to reallocate the current contract with Hilly to the no contract, possibly under better economic terms than the current ones. Therefore, Golar would be making more money, and at the same time they're actually negotiating with several counterparties. They're negotiating an additional asset for which they're requesting the complex units, as they call them, which are the ones that are placed on top of the ship. They're already demanding or placing the order for them. Otherwise, the construction would be delayed. And the company is quite confident that they will land a contract. So this is what we think will happen too. If contracts don't materialize, that would come to us as a surprise to us. because it looks like everything's geared in that direction, not just in terms of the company and the work that they're doing, but also because the industry, the sector demands that, they need that. There's more demand in the industry, plus the company and the management board is working to land those contracts. And if that were not to materialize, then if the investment strategy changes, then we would readjust our position and our strategy too. And I think I answered all the questions then. Vicente, they're asking us about Wilhelmsen. What's the investment thesis? Are we still positive about its value? Yes, we maintain the same exposure to Wilhelmsen. This is one of the companies that we explained last year. The thesis is that the value of the companies is worthy. It's a service equipment company for boats, and they have other companies that participate in the logistic arm of Hyundai, and the logistics side is Globis, and this is something that our colleague Minko knows very well because it's a company that's listed in Korea. So the thesis remains. We think that the sum of the parts is bigger than the value at which the company is listed right now. And there's some companies under this umbrella. Some are listed and some others are not. If we have the holding with the net cash and the value of listed companies, that's 50% above than the current valuation of the company. And there's additionally 2 companies that are not listed that we think are worth at least another 50%. So at least twice. It's a company that has a family behind it, a holding with net cash, and also they're world leaders in the transportation of automobiles and merchandise. So they have a 38% stake at Wilhelm, and they have 15% of the market share at a global level. So it's a leading company, a growing company, and we think that it's very much undervalued. And the question that we often hear is, how do we close this valuation gap? Because if it's so cheap, we could sell the listed asset, and this would yield a dividend that is higher than the current list share price. But they have a long-term perspective of what they've done, apart from paying dividends. It's in the last 2-3 years, we have bought back shares. This year it was 1%. We insisted on the fact that given their balance and their positive cash position, they could do more buybacks. And that would be one way forward. And the other way forward is simplification of the holding. So we think that they have several assets, and for concentrating on some would be another way forward. The shares have recovered quite well since we explained this last year. We continue to have a positive perspective on it. Now, about tobacco. We have 3 questions. In particular, Alberto made one of them. Carmen, you will answer this, I guess. What do you think about tobacco companies at current prices? They're talking about Philip Morris, British Tobacco, Altria. Well, we have a positive outlook, obviously. Otherwise, they wouldn't be in our portfolio. British Tobacco already, joined the large corporate portfolio a while ago, and I don't know whether it was in the end of last year or beginning of this year. It was included in the international tobacco in the portfolio. British American Tobacco is currently listed at the lowest price of the last few years because of their regulatory fears, new products, due to several reasons. And we do think that it is an industry which is an oligopoly of those 4 companies plus some extra ones. But the 4 companies you mentioned have 70% of the market, and that generates a lot of cash. And in developed countries, it's true that cigarette consumption is decreasing, but at the global level, cigarette consumption remains the same. It was the same in 2020 as in the year 2000. Considering the population growth, consumption remain the same. And in those countries where consumption is dropping, then price elasticity is negative, and these companies can actually increase prices and generate growth through sales. And then in addition, in those companies, even though cigarette consumption is decreasing, the use of new products is increasing. The consumption of nicotine-related products continues to grow in developed countries, and these are companies that will benefit from that growth, vapors, etc. And as regulations evolve, it looks like this will also become an oligopoly like the one of cigarettes. So as I mentioned, in spite of the dark clouds or the doubts that there might be hanging around, it's an industry, a sector that still has a positive outlook. And as I said, it's listed at a historical minimum share price. And British American Tobacco, Philip Morris is at PER 15, but British American Tobacco, for instance, all of them are at similar levels, but British American Tobacco is the one that is more exposed to new generation products. So we think that they're better protected than others, and this is why we put an emphasis on them more than on others. We have just received a question live. They said that they were very happy to hear about the investment process, and they wanted to know about the valuation process. What is the model like? Is it a float discount, or is there something additional to it? Well, in general, we always said that it's a relatively simple valuation process, except for those companies in which we can specify cases in the long term very specifically. So we're talking about, for instance, the PER 15 that the market is listed out, and over the last 200 years with a higher multiple for high quality businesses and businesses that focus on commodities with low entrance barriers that are more complicated. We apply a lower multiple, like for instance automobiles, which is below 15. So we always move around that 15% multiple, only for those cases in which it makes sense, because flows are stable, because this can be pre-established in a quite stable manner. We discount the cash flow, and we do our evaluation asset by asset, and then we compare the different valuations. And those that have the greater discounts join our portfolio, and this might be an oversimplification. We have 3 or 4 questions about banks, but basically they all point at why we didn't buy when they were so cheap. And then there's another question about potential corporate movements, talking about Sabadell and BBVA. Doesn't this make it an attractive industry to invest in? Well, I don't know. I don't know why. It would have been very rare that the minimum of 200 that they touched a year ago. I'm sure that we bought at 100. Oh no, but they're focusing on banks. Oh, I thought you said Babco. Sorry, Babco. Not Babco, but banks. Okay, banks. I don't know. We have a very particular opinion that I think we have explained at some points. Correct me if I'm wrong, Juan. Being a shareholder of a bank, it's complicated right now because the P&L is very much marked by regulators. So I don't know whether there's a lot of movement, a lot of freedom of decision by management boards to really plan out well without surprises what could happen in 10 years' time to that P&L. And that really de-incentivates investment, I think. And also because there's no need to actually invest in any industry. No one's putting a gun to our heads. And in the Spanish portfolio, which is where we would invest in banks, we wouldn't be investing in banks in Canada or the UK or anywhere else. And in our Spanish portfolio, we have 100% upside. And we only invest in Spanish companies that we know very well, that we have very good visibility over 5 or 10 years. So we really have a need to invest in banks. And, it's not that we are determined to not invest in banks. At some point, we could, if we don't find value in Spain, and some Spanish banks have the ones that we like. Are at our reach, we could invest in them, but right now there's no fit for them in the portfolio. I don't think there's room for them. Juan, do you want to add anything? No, nothing to add. The team has done such a good job that we didn't have the temptation of investing in overly invented companies. They're asking us the following. Seth Garman, recently in an interview, they shared a comment that Big Alman made. Big Bill said that investing in value is watching a recently painted drawing dry. And the difference between you and I is that I carry a hair blower. And regarding Ackman, they asking us whether we do activism with management teams for them to reach that intrinsic value. They're asking us whether we have done some public activism with open letters. Well, we do calm activism. We always ask companies to buy back shares and amortize them. And in most cases, we see that companies heed us. So we do low-profile activism and behind the curtains too. And we are passive activists. When someone approaches us, when there's conflict and controversy, we take sides, and depending on our position, you could become an activist, but it's more or less passive because 70% of our companies are family owned, and you're not going to confront the family because you're on the losing end, because they have 51%, and it makes no sense to do this. Activism is very expensive, it's very tiresome, it's time consuming, and it makes you lose focus from other companies. You need to be specialist, professional like Bill Ackman, and only have 7 investments, and he's a penny in the neck, and he's always on top of those companies talking to some or others, and it's a completely different business compared to ours. And this will be the last question so that we can stick to the time. It's already 8, and I'm going to join 2 questions. Actually, Marcus was asking us, this is a direct question to you, Paco, what's your take on Cobas' evolution regarding compared to when it was created in terms of the team, the profitability, and what do you make of Cobas in 5 years, and how do you compare this to Santa Comba? Is there anything you could share about the Santa Comba? About the group, actually. Well, I'm happy to say that. Well, we've had problems for 2 years, but right now the target price for some funds is 300. We have been working for 7 years, getting to 300 from 100 is creating a lot of value. This hasn't been recognized yet in the share prices, but it will be undoubtedly, and it'll take whatever it takes. And I'm super happy with the team. We've been working together for many years, and for the last few years we've been quite stable, and it looks like this will be the tone. And in terms of the team, in terms of our relationship with the companies, in terms of where we invest, in terms of our bonds, in terms of our knowledge, I think we're in a very good position. And I would love for the fund to be at 200, but it'll be whenever it's time. Instead of being at 130, it'll be at that point. And you were asking us about the 5-year outlook. Well, if we believe in our targets, and we must, because we have 95% of our savings in here, and of course we will reach those target prices in 5 or 6 years. We will get to the management volume that we have in mind, and as I said in the very first day, we don't have any targets instead of management volume. 0 of that. If you want to trust us, come ahead and join us. We will welcome you with open arms. We don't chase anyone for them to join. We don't like it when customers leave, especially because of them, because we always think that there's great potential, but also because of us. It's unfortunate when people leave. And actually, we've been very lucky in the last few years. They've been complicated, but only 5%. We've had only 5% of exits. And in 2008, 2009, we had a 25% exit level. And this goes back to what we mentioned in the beginning. The education, the training of customers has improved. And this is something that deserves recognition. And this provides stability to the business. So in 5 years' time, I think we will be doing the same. We will be generating value. And I'm happy to say that I have good feelings. The same feeling that I've always had. This is an easy to manage portfolio. Things continue to go up. You let go of some. It's it's such a good portfolio that it's difficult to have new joiners. Last week we were analyzing 15 companies and we could introduce 4 or 5 of them in the portfolio, but we can't. It's such a good portfolio that even for some of them we could go from 1 to 2 to 3, and there's no room for that. I mean, we lack space. We would have to be at 100% instead of 120, and this is a very sweet spot. I don't know about you guys, but I'm very happy, and that's our vision. What about Santa Comba? Well, we actually met what we set out to do in the past, and 25% of the revenue is devoted to several aspects. And actually, right now, Santa Comba is closing its first impact fund in Spain. They already had an African one, and now they have the Spanish one. And the yields are not the main point there. They are important, of course, but there's other criteria that are followed when investing. And this is being closed right now with almost 50 million euros. And it's Santa Comba is also meeting its objectives. And well, thank you very much. The investor relations team will answer those questions that haven't been answered here today. And with this, we can wrap up and close our conference. Thank you very much, everyone, and see you next year.